In this video, we're going to talk about Mullen Automotive, trading under the ticker symbol MULN. There's a lot of volatilities coming out of the financial market at the moment, and we should be careful about which stocks to buy, as well as our exposure and timing of the trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before today's video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to 95 cents before closing the trading day at 98 cents. We should pay attention to the 78 cents level nearby because it was tested multiple times as a support and resistance level. And this, by the way, is also a proof that the price trend has been reversed because the resistance level previously became a support level. This is one of the most obvious signals that the tide is now reversed, making it a good level to watch out for. Over the past few days, the trend of the stock has finally bottomed out of the bearish trend, which makes the current price level an interesting entry point for us. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been obviously bearish, as the stock value of Mullen Automotive lost more than 90% of its value. This is likely caused by the general softness of the sector, and as a smaller cap company, it was probably more affected than others. When we look at the price trend overall, it has been reversing from a bearish trend to either enter into a bullish trend phase or to at least recover from the years to come. One key element to consider is that the sector is still under selling pressure as we speak, mainly caused by the individual volatilities of some stocks and the supply chain issues that will keep affecting the EV sector for the foreseeable future. The trading volume of Mullen Automotive has recently been 83 million shares versus the average volume of 135 million shares. Over the previous 52-week period, its price fluctuated between 52 cents and $15.90. The market cap of Mullen Automotive is currently at $37 million versus the enterprise value of $113 million. The difference between the two is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's relatively less reactive than the market cap since it's updated every single day. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is called goodwill. Goodwill is an expectation or an assumption that a market has regarding this company that it can generate either more profit or to grow faster, because it may have a better management team, a stronger brand recognition, a bigger online following, and so on. It is basically what is unique about this company in particular compared to an alternative competitor. It may not be a tangible asset that companies can use, but it's often the reason why companies are perceived to be trading at a discount, since the market cap doesn't include the goodwill. But if the company goes to liquidation, the goodwill would be gone, and we would be left with potentially less assets to share amongst shareholders and debt holders than what we see on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 90% higher than the 1-month low, 90% higher than the 3-month low, and 90% higher than the 52-week low. On the options market, which gives a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility is 323% versus the historical volatility of 355%. The put-call volume ratio is currently at 0.22. It's normal for most stocks to tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 22,000 contracts in a day versus the 30-day average of 20,000. For open interest, the most recent volume of open interest is 164,000 contracts versus the 30-day average of 50,000 contracts. In terms of its shareholder structure, institutional shareholders own 4% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It is relevant to understand the shareholder composition of a company as it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then this is a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not simply a short-term trade. Obviously, there's a lot of exceptions to this, since many great companies are also mostly held by retail traders, but this is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes there are significant short interest in the total volume, and this can be a sign that there's an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 10% of the total floats and 33% of the transactions coming out of the dark pools. Overall, my opinion on Mullen Automotive is bullish, or at least optimistic, because the stock is at a very low level historically speaking, and the downside is very limited compared to the upside. The maximum exposure I would recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are very close to where the stock is right now. I would recommend to separate the allocation in batches of 25% at a time so that you can have enough room for later purchases. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.